Welcome back, everyone. I'm Kirill Tlai, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Two stories today. First, the market. Where we stand on that big hawkishness call I have made the last two episodes. Because this week we finally got the data to back it up. Inflation came in soft across Europe. Oil is back below where it was before the war. And the dollar looks like it has peaked. I think July is set up well, with one event to watch. And second story, the labor market. We're halfway through the year, so I want to step back and look at where it stands through the lens of AI. Quick disclaimer. Nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with the call we have run for the last two episodes. We said the market had hit peak hawkishness. This week, we got real data that backs it up. So the call still holds, in my view. Peak hawkishness was 2 weeks ago, and from here, the path is towards easing. Difficult to say how fast it comes, but the odds of getting even more hawkish from here are rather low. And let me show you why. Start with oil. As we discussed, it was one of the two important variables. Oil has kept falling. It is back at pre-war levels. It dropped below $70 for the first time since the day before the war. And it is not rebounding. That is the whole inflation scare unwinding in front of you. The one risk here is simple. Oil has to stay down. If it spikes again on geopolitics, for example, the story changes. But as long as it sits here, this is the best possible setup for inflation. Second, we got the June inflation prints across Europe, and they came in soft. In some cases, much softer than consensus expected. Germany printed 2.3% against 2.6% expected. France came in at 1.8%, well below expectations and down from 2.4%. Its first monthly decline in 5 months. Spain held at 3.2%, the stickiest of the three. And there is the part that matters most. It's not only energy coming down, services inflation is coming down too. Services is the sticky one, the part the European Central Bank has been most worried about because it does not move on oil, it moves on wages and demand. In France, services inflation eased to 1.8% from 2.1%. That is the exact piece they said would keep them hawkish. And for the Eurozone overall, we are also seeing services inflation decelerate in June. So, put it together. Inflation is already rolling over in June in the hard data. And that puts the central banks in an awkward spot. The European Central Bank has spent months telling us it needs to hike a couple of times to get inflation under control. And it is coming down on its own because the war ended. And now growth is the real risk. And all that extra hawkishness definitely does not help the business cycle. Now, the US is a little trickier. The US is hosting the World Cup this summer. A one-off event like that temporarily props up services prices, hotels, travels, hospitality. So when we get the US June numbers, the energy side will disinflate just like Europe, but the services side might not show it yet because of the tournament. We get that print in the middle of July, so we'll see. But the direction is the same as in Europe. And wages are not reaccelerating yet in the US, which means no second round effects on inflation yet again. Now, there's one event to watch this week. The new Fed chair, Kevin Warsh, speaks Wednesday at the central bankers gathering in Portugal. His first time on the world stage, on a panel with the other major central bankers. He might hint at how he's reading inflation. He might give us nothing. So far, he has looked like an unconventional chair, one who doesn't like to tip his hand going by his past press conference. He has also mentioned that he prefers the market to guide the central bank on inflation. Well, the market is very loud and clear on where inflation is going. Let's see what he says. His speech is also important because it will move the dollar, which is the other important variable. Last episode I mentioned it had broken out above 101 on the dollar index, and I said that was the risk to the whole view. And here's the good news. It looks like it is peaking, maybe only locally, but it has stopped marching higher. The breakout is contained. It is not extending, and that is exactly what I wanted to see. And the rates agree. Yields have moved lower. We did get a small backup on Tuesday on the strong jobs openings report and on Secretary Basson hitting that the payrolls report on Thursday will be strong. And I will come back to that report in a second story because it matters, but the bigger move seems lower. So where does that leave the call? Everything is going to plan. The dollar broken out, but it's contained. Inflation is rolling over in the data already. The setup is good. What we're waiting for now is the next phase, the central banks actually admitting it. The moment they say, fine, inflation is coming down, we're done hiking, or in some cases we never were, and maybe we even start cutting at some point. That is what comes next, potentially late summer. So July looks good for risk assets, and the only real unknown is Warsh on Wednesday, just after I record this. As long as he does not say something that lights up the dollar, the backdrop stays good. One last point on July. June was a volatile technical month. A lot of leverage in the AI trade, a lot of forced rebalancing, and that is what drove the volatility. That phase looks done. Seasonality is good for July, for the Nasdaq and the S&P. The next real catalysts are the US inflation report in mid-July, then earnings season in late July and August, and we'll get into those when they arrive, of course. Now, the second story, the labor market. We're halfway through the year, so let me give you the overview. And let me give it to you through the lens I think is most interesting right now, which is AI. The simple idea is that if AI is going to change the economy, it must show up in the labor market. Start with the monthly jobs numbers from the beginning of the year. The headline looks fine. We had a weak patch in the winter, but the spring months and a little bit in summer, all printed solid, between roughly 170 and 215,000 jobs. And unemployment has held at 4.3%. On the surface, a healthy labor market. But look at where those jobs come from. Every single month this year, it is the same three buckets: healthcare, government, and leisure and hospitality. In the latest months, those three were basically the entire number. The white-collar economy, information, professional services, finance, created next to nothing. The information sector, which is the cleanest read we have on tech, is down around 340,000 jobs from its 2022 peak, an 11% decline. And one caveat that makes it look even weaker, part of that hospitality number is the World Cup, temporary staffing for the tournament. So strip out healthcare, government, and the World Cup, and the private white-collar economy has barely added a job in over a year. Here's why I read that as the AI signal and not just a soft patch. These white-collar sectors, finance, information, professional services, normally add jobs every single year outside of a recession, like clockwork. Instead, they have been cutting on that for 3 years, while the overall economy keeps growing just fine. A growing economy with a shrinking white-collar workforce does not happen in a normal cycle. The companies are not firing in waves. They have just stopped hiring. The job openings report this week told the same story, and it is the report that moved rates on Tuesday. On the surface, it looked strong. Openings beat around 7.5 million, well above what the market expected. But look at what actually drove it. Every sector that added openings was blue collar. Wholesale trade led, up 70,000. Then manufacturing, construction, hospitality, the physical economy. And the white collar side went the other way. Finance openings fell. Professional and business services were flat. The demand is for people who move things and build things, not for people at a desk. And on top of that, companies are posting these jobs and not really filling them. Hiring stayed weak, and the rate at which people quit for a better job is near its lows. Postings up, hiring down. And all of it on the blue-collar side. So that is one side, the freeze. Here's the other side, and it is more optimistic one. The same AI that is freezing corporate hiring is arming the individual. Look at the new wave of AI startups. They're built by tiny teams. About a fifth of them run with 1 or 2 people. And they operate at half the headcount of a normal startup. The whole point is that a couple of people, sometimes one, now do what used to take 50. And the solo operators, one-person businesses, are reaching a scale that was not possible before. The share of them earning over $1 million a year is up around 6 times since 2019. Over 5 million, up about 5 times. One person with AI now does the research, the contracts, the compliance, the payroll, all of it off the shelf. And that has a real victim, the professional services firms. Consulting, IT services, outsourcing. If one person with AI can do the work and charge a fraction of the fee, those firms are in trouble. And the market is already pricing it. Accenture, the consultant that was supposed to win by rolling AI out for everyone else, has watched its valuation collapse, down 68% since February 2025. A huge decline. So that is the labor market through the AI lens. The headline says 4.3% and fine. Underneath, the white-collar economy has stopped hiring and the work is shifting to AI, to tiny teams and to blue-collar workers. Before I wrap up the scoreboard, as always, this last week we got hit by a slightly stronger dollar and one company made an acquisition and its stock dropped, which I think should recover quickly. So, to pull it together, the big hawkishness call is playing out, inflation is rolling over in Europe, services included, oil has round-tripped the war, and the dollar is contained for now. I stay risk-on into July, and the one thing I'm watching is the dollar. And the labor market looks fine on the surface, but underneath it is freezing in exactly the white-collar sectors AI is starting to do itself. While that same AI arms tiny teams and solo operators to compete with the firms that used to employ them. That's it, guys. If you got something out of this, hit subscribe and like, and I see you next week.